Hi, what I'd like to do now is to spend a little bit of time talking about accounting for agriculture and demonstrate the application of fair value accounting to agricultural activities. To do so, what I'm going to choose is a simple example of a firm which is growing apples, an orchard, and during the course of the year, the firm incurs fertilizer costs of $25,000, pruning costs of $100,000, and at the end of the season, the firm harvests apples which have a fair value of $100,000 and there are costs to sell of $2,000. Harvesting costs $8,000 and these apples are eventually sold for $105,000. Selling costs are $2,500. So let's just work clearly through the accounting processes here. The first thing we need to understand is that during the year we're going to incur some costs. We can either regard those costs as expenses or as attributable to the apples that are harvested. It's not going to make a difference, and I'll explain this later on. So what I'm going to do initially is just treat the costs incurred during the year as expenses. There's a fertilizer expense of $25,000 which I'm paying. There's also a pruning expense of $10,000 which is being recognised. That brings us to the end of the period or the end of the season when we harvest the apples. And at the point in time which we harvest the apples, then they become separated from the biological assets, although in this instance they're bearer plants, so they're outside the application of the relevant accounting standard here. They'd be accounted for as property, plant, and equipment. And I'm going to recognise the apples when I pick them, so they become produce. And when I pick them, they become inventory. So when you harvest the apples, they become inventory. You'd recognise the inventory at the fair value, less the costs of sale when you pick the apples. So what you can see here is that I'm going to recognise inventory at the fair value, less cost to sell of $100,000 minus $2,000, $98,000. I'd recognise the harvesting costs of $8,000. And I'd recognise a gain on the harvesting of the apples of $90,000. So what you can sort of see happening here is that we're assuming that our business model is growing apples, and we're recognising the revenue when we actually harvest those apples. That's the conclusion of our business model cycle. What then happens is that we'd sell the apples, and recognise the inventory as a cost of goods sold for $98,000. We'd recognise the sale of the apples for $105,000. So there was a change in the value of the inventory between when we harvested and when we sold it for $7,000. And we'd recognise some selling expenses, $2,500. What this gives us at the end of the day is an income statement, and this income statement is a little bit unusual because what you can see here is that if you look at the revenue section, you can see that there's a relatively small margin or profit on the sale of the apples. The apples revenue is $105,000. We're recognizing a cost of goods sold of $98,000. So there's $7,000, which is the relatively small gain on the sale of the apples. But instead you'll see there's a very, very large gain on produce, the agricultural produce, the apples which you recognized when you harvested them. So what you're going to see here is that with fair value accounting in an agricultural context, there's quite a different recognition point for revenue. It's when the value changes rather than on the realization of the apples. That's a feature of fair value accounting. From those revenues, we deduct the expenses. There's my fertilizer expense, $25,000, pruning, $10,000, and the selling expense, which gives me total expenses of $37,500, and at the end of the day, a profit of $59,500. Now, I mentioned earlier that I was going to treat the fertilizer and pruning as period costs rather than attributable to the apples. What I want to do now is to spend a little bit of time talking about two issues. One, why that decision doesn't matter. And two, perhaps more generally, why we don't seem to have any concern with what are costs with a fair value accounting standard, or what are the costs in terms of agricultural activities? Does it matter? So what I've done here is I've recast the income statement, and I've recast the income statement, and instead of treating the fertilizer and pruning as being period costs, I've treated them as being part of the costs of producing the apples. So we're going to recognise the apples still at $98,000, but because I'm recognising more costs as associated with the production of the apples, it's going to reduce the gain on purchase to $55,000. So you can see that I've removed the expenses from the expense section, and it's reduced the gain on production. However, what you can see is that at the end of the day, it doesn't change the profit that we recognise. It's still $59,500. And what this is sort of telling you is that with fair value accounting, it doesn't matter what costs you recognise as being attributed to the asset or not, because at the end of the day, that's exactly offset by a change in the gain on production. Quite obviously, if you attribute more costs to the agricultural produce, then it's going to reduce the gain on sale, but it's also going to reduce the expenses, and this is going to be exactly offsetting. That's why there's not much concern with how we account for the costs incurred in the production process, the agricultural process, and why we have so little concern with what goes into the determination of the cost of agricultural produce. Because at the end of the day, it just doesn't matter. It all gets balanced out at the end of the day.